This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Nick Galarnik is away this week, so let's get to that post-game chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Eric Peters' picture saying looking for the downloads. Now, Eric, let's cover crude oil, starting with the EIA inventory data.
Crude oil printed a drawdown of 4.5 million barrels this week. Cushing, Oklahoma printed a very small 116,000 barrel build. That was a nice little bit of help, but not nearly enough to solve the problem there. They're still just barely above their operational minimums. And we also have big drawdowns on the finished products, with gasoline drawing down 1.5 million barrels, distillates drawing down 2.2 million barrels, for a net petroleum products drawdown of 8.2 million barrels. U.S. production ticked down 100,000 barrels to 13.2 million barrels. Oil rebounded nicely, about $7, more than $7 now, off its September 9th lows, but the rally is now struggling. As of Wednesday's close, we're still holding just barely above that 69.09 13-day moving average. That's the critical short-term support level. If that breaks, I think we could see significantly lower numbers from here.
Yeah, Eric, so many commodities have turned up on the China story, but crude oil is not one of them. The pattern of lower highs, lower lows, primary downtrend channel remains intact. The entire rally over the last 2 weeks was simply a retest of the 50-day moving average, and so far we've rejected there. Now, overall, I think we're actually very close to the bottom end range of crude oil. I don't think there's a huge downside risk, but that doesn't make it immediately bullish. It's entirely plausible that we stay in a range-bound area down here, even past the elections, and therefore, even if we dip temporarily down to $65, it could return right back to $72 and then just consolidate sideways. I think it's more of a trader's market on the short term. We're looking where the bottoms finally establish themselves for a potential new bull signal, but right now that downtrend is quite intact. Let's move on to equities. The S&P continues to rip. What are your thoughts here?
Well, Patrick, you could make either of a couple of arguments here. One would be to say this market clearly is overbought on a technical basis. You can also make the fundamental argument that with a lot of people eyeing a recession, there's lots of reasons to think that equities are overvalued here. The counter argument, frankly, is the Fed is political, and they've decided to juice this market through the election, and that's what they're going to do. And it's probably almost certain to continue through the election. Sorry to be cynical, folks, but I'm going to go with the latter. I think the Fed is political, and I think they are goosing the economy to support the election, and I think it is going to continue.
Yeah, the bull market has been relentless. The pattern of higher highs, higher lows, the trend continues to be quite intact. The only thing here is that now many different measured moves are targeting these areas near 5,900 on the upside. So while the trend is higher, the accumulation is very clear. The flows continue to show that pattern of moving higher. But on the short term, I think we're approaching where the upper boundary of this move will be. Now, the bigger question is, will when we put in a short-term top, it simply be well defended and bought on dip, or will we see a deeper pullback that, let's say, violates a 50-day moving average? On the short term, at this stage, I think we may even continue this pattern right up until the jobs numbers. So it's entirely possible when we're recording next week that the market's still up in these elevated areas. The bigger question is something like the jobs numbers next week offer a catalyst for some sort of profit taking. All right, Eric, let's talk the dollar.
We're still consolidating between 100 and 102. So far, every test of 100 has been firmly rejected. I expect that round number support at 100 will eventually fail. When it does, I think there could be an acceleration to the downside. But as long as that 100 round number level is holding, we're going to continue this sideways consolidation.
Yeah, Eric, it's interesting that the US dollar remains in its primary downtrend. It continues to be distributed, but there are some key inflection points here. The euro is testing a very critical 112 resistance level. We're going to find out whether or not that currency can beat that level. I think it's going to be critical. And at the same time, it's clear that the US dollar yen has established at least a short-term trading low. And the bigger question is this a bigger retracement where we could temporarily see the US dollar yen trade back to 150? The moves in some things like the pound sterling are now getting very robust and overextended. So it's entirely possible that this is going to be, at least on the interim, where the dollar may settle down and establish lows. The bigger question, does that then turn around into a US dollar bull rally? And that has not shown any sign yet at this stage. Let's just see where the short-term support lines establish themselves. I think it would take a break above that 102 level that you just mentioned that would start to signal to the bulls that maybe there are bigger reversals underway, but there's no sign of that yet. All right, let's talk precious metals. Let's start with gold here.
Patrick, I think this week's trading action marks a very important new development in this gold bull market. Yeah, we're up this week, but we're not just up. We broke through several important technical levels, and we broke through those levels with gusto, barely even pausing before breaking through each of several different levels. We're back to extreme overbought on the slow stochastics, but frankly, just as market crashes begin from an oversold, not an overbought condition, the really beautiful melt-up in gold prices that I think might be coming would begin from overbought technicals as opposed to oversold technicals, and that's exactly where we are right now. Bigger picture-wise, though, we do need to take stock of how far along we are in this bull market. The target of that long-term, decade-long cup and handle pattern is 2724. That's the pattern that goes back to the blow-off top in 2011. That was targeting 2724. We didn't think we'd get to it this year. We're almost there already. So we need to start to think twice about how far along we are in this market, but I don't think it's anywhere close to over. It does make sense, though, to remind ourselves that we've come a long way to the upside, so there's plenty of room for significant downside corrections without disrupting the overall bull trend.
Yeah, Eric, that 2,700 target was something that we've talked about numerous times on this show, and here we are, and so gold is approaches now. There are some bigger weekly measured moves that are to 28 and 2,900, so I don't want to already be fading this gold rally just yet, but it does feel, at least on the short term, that this has played its course and is due at some point just to pause and consolidate. I actually remain super bullish gold in the bigger picture. The one thing we're just technically trying to observe is the ebbs and flows of some of these overextended markets and where short-term buy on dip opportunities emerge. At this stage, I don't see a lot of asymmetry in putting on brand new gold trades until there is a dip, and we're watching closely what we're up along here where the gold market runs out of a little momentum. But it will be interesting because I have on page 6 the chart on silver, and silver is just attempting to break out to its new year high up at $32 and change. It could be possible that there's still one more bull impulse here where gold, let's say, puts another $100+ an ounce on the upside, while silver has some sort of catch-up rip where if it breaks to these fresh new highs, that we have a $2 or even $3-4 advance in silver up to the $34-35 plus dollar areas. Will be certainly a way that on the short term that these precious metals can play out. Let's watch whether silver can make that break. I wanted to just on page 7 highlight the copper chart, and we've been generally observing the distribution cycle that copper has been in relentlessly for the last 3 months. We were watching at what it was doing along that 50-day moving average several weeks ago, but really this China monetary bazooka storyline really flipped the script, as many of these commodities that have been beaten down with the backdrop of a weak China suddenly are getting a little bit of of tailwind. This breakout here on copper has actually beat some key fib zones and is now spending a solid time consolidating above its 50-day moving average. If we see this price level being well defended and we see old dips being bought and it stays above 4.25 on pullbacks, this could be a very key turn point in commodities, something that would be welcome from the battered commodity bulls. Will we see this turn at this stage? These are the key kind of turn points that can develop into new trends. So you can't ignore these kind of turn points, especially when they're given a catalyst that way. On page 8, I just have the natural gas chart. It's interesting that while we see both gasoline and oil under continued pressure, natural gas, at least from a seasonality perspective, is really starting to turn up as we're now going into the fourth quarter, where not only do we see nat gas roll up the term structure to winter gas, but we're certainly now seeing some of the even front month contracts actually getting bid. So that right now nat gas turning up. Will we see a move of the similar magnitude as we saw May and June, especially with a number of hurricanes and other things forming that could create supply issues? Nonetheless, nat gas definitely turning up. A retesting of its January and June highs seems like a very reasonable short-term target. Let's move on and talk about uranium here. What's your thoughts?
Well, I just love how civilized this market is. Several people had predicted that the WNA conference in London would be the pivot moment, the catalyst event to turn this market around. And practically as if it was scripted, the bottom in the uranium market appears to have occurred at the last day of the conference. That was September 6th, and has been going straight up on improving news flow ever since. So hopefully the bottom is finally in for this market, but of course anything is still possible. The big news this week was Friday's announcement of Microsoft signing a 20-year contract to buy energy from the restart of 3 Mile Island's reactor number 2. That's of course the one, not the one that melted down in 1979, but the one right next door to it, which was just shut down in 2019. So they're going to restart that reactor for Microsoft. Then there was more bullish news on Monday of this week. Our friends at ENEC, that's the Emirates Nuclear Energy Company, hosted a big shindig in New York City, basically organizing bankers to support the triple nuclear initiative. So now we not only have 25 nations around the world having pledged to triple nuclear energy by 2050, but we have all of the major banks signing on to say, yes, they're ready to finance the building out of that tripling of nuclear energy by 2050. So lots and lots of bullish signs. So far, though, the spot price of uranium has yet to move. So let's continue to watch this market. If we don't see some action on the price of uranium, I could easily see prices dipping back down despite all of the bullish news. So let's watch for an actual move on the price of uranium. When that happens, I'll really be confident that the bull move is on.
You know, when we talk about hopefully the bottom is in, what is encouraging is that both August and September saw the lows establishing themselves, where basically it was trading in its primary downtrend, staying below its moving averages, but it stopped going down. A lot of those sideways consolidations are quiet accumulation areas, forming things like double bottoms and other things that eventually turn up. Obviously, this really nice kickstart that we saw not only in the uranium but also in uranium equities has now gotten many of these above their moving averages, breaking multiple highs that they established in August and September. So these types of things are often there when potential new bull trends are underway. And when you stop and reflect on after that enormous 2023 bull run, we went through an 8-month consolidation in this, which kind of took out all of the bullish excess that was built in the last impulse. There is plenty of pent-up energy that if this story turns around, that we really get things going on the upside. Eric, I just want to touch on two more charts. On page 10, I have the Bloomberg Commodity Index. And I did this on a weekly chart so we can really zoom out and see what's happening here. What we had was an enormous bull run from 2020 out to 2022. And now we've gone through a 2-year consolidation in the broad commodity basket. We saw that in the grains. We saw that in all sorts of metals and iron ore and other things like this. And suddenly we have this slowly trying to tick up above its 50-week moving average. Now, we have not officially seen breaks to higher highs, higher lows, consolidations that are showing a new bull trend is underway. But this is going to be very interesting to see whether or not this is a turn point in the bigger picture. As you can see, it's very, very early. We don't even know if it's the first inning of a bull run. Overall, I do believe that we are in a secular commodity bull market. So if this really starts to show signs of life, we can't ignore it. Finally, on page 11, I have the 10-year U.S. Treasury yield. And what we really have seen was that the FOMC was a buy rumor, sell news on bonds. The yields did come off of those lows near 360. At this moment, I think that the bond market is going to take a moment and a pause to really size things up with the amount of rate cuts that are being priced in for next year. If, in fact, we do have a soft landing, which is not my favorite scenario, but possible, then the market may just be pricing in too many cuts, and all of the bonds, whether 10 years, 2 years, all of them might just mean revert and give some of it back to come back to a more stable level. I'm at this moment think that there's room for yields to retest even 4% on the interim while we see where the next kind of major economic data points are turning the economy.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.